What if I told you that Warren Buffett uses just 3 numbers from a financial statement to know the perfect time to buy a stock? And even better, he has a simple rule that tells him exactly when to sell? Most investors panic during market crashes and chase stocks when they're expensive. But Buffett does the opposite. And today, I'm breaking down the right time to buy and sell chapters from Warren Buffett and the interpretation of financial statements, the book that reveals his actual decision-making process. By the end of this video, you'll know exactly what financial metrics Buffett watches and how you can use them to time your investments like a pro. Let's dive in. Lesson number 1. Buffett's first timing indicator is return on equity, ROE. Here's the rule. He only considers buying companies with a consistent ROE above 15% for 10 years.
Why?
Because high, consistent ROE means the company has a durable competitive advantage. It's making excellent returns on the money shareholders have invested. When a company with a 10-year track record of 20% plus ROE suddenly drops in price due to market panic, that's when Buffett buys. Example, Coca-Cola's ROE averaged 30% plus 4 decades. During the 1987 market crash, its stock dropped 25%. Buffett bought aggressively.
Why?
The business hadn't changed, only investor fear had changed. Lesson 2. Buffett wants companies that can pay off all their long-term debt with less than 3 to 4 years of current earnings. This is crucial for timing. During market downturns, highly leveraged companies get destroyed. But companies with little debt? They not only survive, they thrive by buying up distressed competitors. Check the balance sheet, take total long-term debt, divide it by current annual net income. If it's under 4, and especially if it's under 3, you found a resilient business. When the market crashes and everyone's panicking about debt, that's when you scan for these low-debt champions trading at discounts. Lesson number 3. Now here's where timing gets mathematical. Buffett only buys when the stock trades at least 25 to 30% below his calculated intrinsic value. How does he calculate intrinsic value? He projects future earnings based on historical growth, then discounts them back to present value. But here's the practical version. If a company consistently earns $5 per share, and similar businesses trade at 15 times earnings, that's a $75 intrinsic value. Buffett waits to buy at $50 or less. This is the timing mechanism. You're not trying to predict market bottoms. You're simply waiting for fear to create the discount you need. During 2008 to 2009, dozens of excellent companies traded at 40 to 50% discounts to intrinsic value. That was Buffett's biggest buying opportunity in decades. Before we talk about when to sell, let's talk about when not to sell. Buffett's golden rule: if the durable competitive advantage is intact, never sell, regardless of how high the stock price goes. This is counterintuitive. Your stock doubles. Don't sell. It triples. Don't sell. It goes up 1,000%. Still don't sell.
Why?
Because if the business continues generating high returns on equity year after year, the intrinsic value keeps growing. The stock price isn't too high. It's simply reflecting the compounding power of an excellent business. Buffett bought Coca-Cola in 1988 to 89. It's up over 2,000% since then. Has he sold?
No.
Because Coke still has its competitive advantage. People worldwide still prefer Coca-Cola. The moat is intact. See's Candies. Berkshire bought it in 1972 for $25 million. It's generated over $2 billion in cumulative profits. Did they sell when it doubled?
No.
When it went up 10x?
No.
They still own it today. Remember, your best investment isn't your next investment. It's holding your great investments longer. So when does Buffett sell? Here's the simple answer. Lesson number 1. When the durable competitive advantage disappears. Specifically, watch for ROE dropping below 15% for 2 to 3 consecutive years. Gross profit margins shrinking consistently, the company needing to take on significant debt to maintain operations. Management making desperate moves, unrelated acquisitions, accounting gimmicks. Remember, Buffett held Coca-Cola for decades through multiple market crashes. He held American Express for over 50 years. He doesn't sell because the market goes down. He sells when the business fundamentally changes for the worse. Now, the second legitimate reason to sell, when you found a significantly better investment opportunity. Buffett calls this opportunity cost. Your money can only be in one place at a time. Here's the decision framework. If you own Company A with a 15% ROE trading at fair value, and you find Company B with a 25% ROE trading at a 40% discount, it might make sense to sell A and buy B. But, and this is critical, you need a significant improvement in either. The quality of the business, much higher ROE, stronger competitive advantage, the discount to intrinsic value, much cheaper price relative to value, or preferably both. Don't sell a great company at fair value for a mediocre company at a slight discount. That's a mistake. Third sell signal. When the stock price rises so far above the long-term economic reality of the business that it becomes absurd. Notice Buffett doesn't say, sell when it's overvalued by 20%. He's talking about extreme overvaluation, when market euphoria pushes prices to levels that make no mathematical sense. How do you identify this? Compare the stock's implied growth rate to historical reality. If a company has grown earnings at 8% annually for 20 years, but the current stock price implies 25% annual growth for the next decade, that's a dangerous disconnect. Calculate it, take the current P/E ratio, compare it to historical averages. If it's 2 to 3 times higher than the 10-year average, and there's no fundamental reason for improved business performance, the market may be in euphoria mode. Buffett famously trimmed some holdings during the 1999 tech bubble, not because businesses were failing, but because prices had become completely detached from underlying economics. But be careful, this is rare. Most of the time, if the business is excellent, just hold. Okay, so how do you actually apply this? Here's your action plan. Take a screenshot. Look, Warren Buffett became one of the richest people on earth not by trading frequently, but by buying great businesses and holding them for decades. Most of his wealth came from just 10 to 15 investments he held for 20-plus years. Warren Buffett and the interpretation of financial statements gives you the exact roadmap. The chapters on timing are masterclasses in patience, discipline, and knowing when to act, and more importantly, when not to act. If you found this valuable, smash that like button and subscribe for more book breakdowns that actually make you money. Until next time, invest wisely, think long-term, and remember, the best opportunities come to those who wait, and the greatest returns come to those who hold. Thanks for watching. This is Guide to Wealth, where powerful ideas meet practical action.